Let's go.
Stage again, talking about the evolution of strategic venture capital. More corporations than ever, as we know, are investing directly into early stage companies and funds with the goals of implementing technology to improve their businesses while also providing equity. For startups, there are advantages, of course, to taking capital from a strategic source, but there are drawbacks as well. So we're going to get into a panel here to demystify what's happening in the world of strategic VC. Our moderator is a senior associate at Shadow Ventures who started his career in corporate finance before transitioning to the startup world. Please welcome Nick Durham and our entire panel to the stage.
Thank you, Dana. Thank you, Dana. Quick check-in. How's everyone doing? Is everyone all right? Feeling awake? All right. Maybe a little bit cold. Maybe just me. So welcome to the Strategic VC panel. So we thought this would be an entertaining conversation to have with this group, specifically because there's a lot of startups in here. So before we kick it off, I want to go ahead and pass it to the panel. Ty, we can start with you with quick introductions.
Sure. Ty Finley, Vice President with the Pritzker Group Venture Capital team. We're a Chicago and LA-based Series A focused firm. Spent a lot of time in the broader real estate and construction tech ecosystem, actively investing in it. Hence why excited to come down to Shadow Summit. Thanks for having us. I think there's a great ecosystem forming here. And then prior to my time at Pritzker Group, I was at GE Ventures in their corporate venture arm. So I've had a chance to see this rise of corporate venture and what strategic capital looks like, and happy to share some thoughts.
I'm Meg Paulus. I'm a partner with Holt Ventures, which is the strategic venture capital arm of Holt Cat. We're in San Antonio, Texas, and we're the largest U.S. dealer for Caterpillar. So I focus broadly on construction technology and now kind of focusing on anything that could impact our customers or our operators. Prior to Holt, I was at BlackRock on the private equity team. So this is a bit of a change up looking at earlier stage companies, and I'm really enjoying the creativity and to get to work with people like Shadow and learn about the market.
Hi, I'm Momei Q. I lead real estate tech and construction tech investing for PSP Growth, which is Penny Pritzker's private investment group. So it's nice to see audiences from both real estate as well as construction at one conference, which is not always the case. Before PSP, I spent a little over 10 years in the venture capital space investing in various B2B software verticals. And PSP, I would say, is a bit unique in that how we're strategic depends on what stage of investment that we participate in. So our sweet spot is more traditional growth equity investor, where a company reaches a Series C and they need help with business building strategies, such as thinking about scaling quickly, how do you think about international markets, including capital markets. But we also participate as part of the syndicate on earlier stage investments in probably the more traditional strategic investor way, where we have a direct real estate group that focuses on multifamily and industrial investments. And we also have a ground-up construction team that could be a test bed for some of the construction technologies.
Yeah, so I had a few conversations yesterday with a couple startups here, and it seemed to me that everyone was unclear on kind of what the definition of a strategic is. And I was kind of surprised by that. It's a label that's like pretty well known in the financial space, but for startups, I totally get it. It's the financial, the burden of understanding investment terms and the language that's spoken can sometimes be pretty heavy. So what I wanted to do to start off was like, if anyone wants to offer a definition of what strategic venture capital actually is, so some of our startups can be more clear on that. Anyone can take it.
I can take it. So I guess I would say strategic venture capital is, or just strategic investors broadly, are firms that are looking to not just be a financial investor, meaning look for a return, but also are looking at if they could be a customer or if their customers could be a customer, and more broadly are focused on the fit within the markets that they're focused on. Just to use some contrast, I would say, firms like BlackRock, where I came from, is a financial investor, right? They don't necessarily care what market you're in, and they're not going to do any work on your integrations, but what they're looking for is a financial return, and that's all you're held to. Versus when you're looked at from a strategic angle, it's how do you fit and how can we help you integrate into different markets.
So I think this is a really fun question because I think the definition is changing, especially over the last 5 years, into almost a blended answer where you can't really tell the difference, if in my opinion, of how they're coming at it. So just to put in perspective, I was looking at some PitchBook data from 2018. When they say corporate venture capital, I think they said that corporate venture capital was involved in over 1,000 deals last year, and that was an 11%-ish growth year over year, so it's only continuing to get more and more. There's over 200 or so unique corporate venture capital groups, and that continues to grow as well. And then maybe the most interesting stat to me was corporate venture capital, and you need to define that, was about 50% of all the capital allocation into the venture capital asset class last year. And that obviously is into the growth side of the equation, where maybe you throw SoftBank and some more debatable names in there. But the point still remains, a lot of money is being put into this from the corporate venture capital or strategic bucket. And the reason I think things are changing, especially in these industries such as prop tech or construction or supply chain logistics, I think you're seeing firms like CBRE and others start to put their money behind certain venture capital groups that have, call it a clubbed up, mafia-ish of LPs that really know that domain, to have a dedicated investment team that also has a strategic mandate. So you have a financial incentive to keep your team members there, but you also have a strategic rationale. So I think the definition is quickly changing, and apologies to the founders as we all try to figure it out together.
I think especially this industry, because I've had the experience of working across a lot of different sectors, and real estate and construction is by far the earliest where strategics have gotten involved. And what I mean by that is usually you see maybe a period of 5 years where capital is coming from more traditional financial investors and venture capitalists. And then the strategics observe, they test it out as a customer, but they don't actually make an investment until usually maybe 5 or more years after. Here in real estate and construction, you almost see them going in parallel. And I think to Ty's point, that's part of how the ecosystem's evolving. And when you think about the difficulty and the steps involved with launching a technology commercially in these sectors, it starts to make sense because you really want to have some of these people be champions early on because sales cycles can be long. You need all the help that you can get, so you can have people on your internal team, and by being an investor, they almost become part of your internal team. Then you definitely get a leg up over competition in the industry generally.
Yeah, that's good. I didn't expect you all to answer that question, but I think
we're fired up about this topic,
from that. So what I kind of got from that was the incentives are different, right, for strategic investors versus a financial investor like Shadow. So I think incentives in business are the key to everything, right? Understanding those kind of unlock strategy. So can you so I think Meg, this would be a good question for you, and then Ty, maybe from your GE days, and Momet, if you guys can weigh in on a little bit of there's shorter term value that's captured from a strategic investment, and a lot of times that leaves some of the financial incentives for the strategic, want to understand how they balance that strategy. And then from the startup perspective, I think, there's less incentive. We've talked about this a bit, but there's less incentive to really understand your cash position. And your greatest risk as a startup is running out of cash, right? So understanding that, if a strategic does invest in you, you still have to operate your business and go out and find other customers, and navigating that while also treating your best and first customer very well, I think can be a challenging balance. So yeah, incentives.
So I can start with that. So We have a little bit of what I would say is a unique approach in that we really at Hold have an operator first mentality. And so when I'm sourcing new deals, usually I'm looking at, is this something that could be integrated into the dealership or that we could offer to our customers and provide additional value? So I'm not first looking at what is the financial position of this company and could we make a return. I'm first looking at how could we impact this industry together. And so I think that it goes well to your question of what are the incentives, because instead of us thinking first of the financials, we're thinking about could we impact something together. And so I can give an example of a company called Drop-Off that we recently invested in. So when our technicians are in the field, they almost always don't have all the tools that they need once they go through diagnostics. And so we ran a pilot with this company called Drop-Off to see if they could go and get the parts from our warehouse and get it out to the technicians faster and, kind of reduce the wear and tear on our vehicles and also reduce the ultimate pricing to our customers because the technician is staying there and still working. And so we went through this pilot, and the ultimate thing that came out of it was they're not getting there fast enough. So why would we keep doing this? And so we did an operational change where we requested the part at the same time as when the technician actually finished their diagnostics. And then we got to the investment decision where we said, yes, this is making a huge impact on the efficiency of our technicians, and now we can look at the financials. And so I think that is where it helps for us to co-invest. So, we can kind of do it all from the strategic angle through the financial angle, but I do think it's helpful to work with someone that is their sole focus is on the financial side and helping the startup manage their cash burn rather than focusing exclusively on how do you fit within our business.
I would say the same thing in terms of we also have, a financial angle, and probably a stronger one than some of the other groups in that we don't need to have a strategic angle in terms of our groups, our real estate and construction team being customers, but we can. But what we really focus on is, even at the very early stages, instilling business discipline in the companies, because you tend to think even as a strategic investor, yes, you have strategic value, so some strategics might not be as on top of can the company scale, can the company grow, but some of the things I'm hearing over and over again is that even from a strategic perspective, they're coming to us and saying, we don't want to invest or be a customer of a company that's not going to be around in 2 years. And that has become a real challenge in recent years as the space has gotten more crowded, as people do more and more pilots without really the intention of continuing on with the business. So how do you manage cash, and how do you, even at a Series A stage, think about going concern, I think is really important. And I think when startups are looking at their syndicates, it's very easy early on to just want a syndicate of all strategics because they're your customers. They can do more than just give you money. They can give you money and become a customer. But I think one is, on the business discipline side that I mentioned before, that where it might make sense to bringing a financial investor in conjunction with the strategic. But the other part of it is a lot of strategics that I know, they don't tend to invest in follow-on rounds. They want skin in the game because they want to be a customer, but once they have skin in the game, they have skin in the game, and so you have to continuously think of other sources of capital as you go on with your fundraising, whereas a financial investor oftentimes kind of support you from the earliest stages. So just something to think about as you round out your syndicate, that strategics play a very specific and important role, but the financial side is also important as you think about building a sustainable business.
Yeah, and I'll just keep promoting this fact that I think, and it's evolving, so you're not always going to find everyone on this end of the spectrum. I think you want to be looking for strategic investors who have a blended agenda, where there's a financial return, that individual, the person who's going to go internally and champion you to go to the business units and get the pilots and do all the things you want them to do, they need to have a financial incentive to actually sit in that chair and not just rotate to another innovation group in the company, or quite frankly, go find their next best opportunity where the financial incentives as an investor may be a little bit better. So if they're able to blend that and then also have the strategic roots and know how to navigate the business units, I think that's the type of person I'm looking for, because it fits into all kinds of nuances, even what Monet mentioned about follow-on, so that you know that that person, if they're financially incentivized, they'll be wanting their pro rata rights. You'll have a little more capital around the table whenever that next round comes. So again, I think we're evolving into the notion of more of a blended outlook, but we're not completely there yet, but those are the people I'd be looking for.
Looks like we all answered your question again.
Well, you guys were allowed to that time. So, want to understand, I think like for all the founders, navigating the term sheet and just governance broadly when working with a strategic can be a bit challenging, right? Like, again, they're your best customer. And then also, you're also building a separate, a separate entity, right? They didn't buy you. So the challenge becomes, how do you go out and find new customers? How do you grow your business successfully while still maintaining and building a great relationship with that strategic investor? So want to understand, like, a little bit of how you guys approach terms with startups, because of course you want to unlock, like, you want to be that first customer pilot. You want to have that access. Maybe you don't want other competitors to have that access, but you also want the startup to succeed. And there should be a mutually understood benefit that we need to have the startup's best interest in, at heart here, even when financial, incentives and strategic incentives can be somewhat misaligned there. So yeah, I wanted to hear your guys' perspective on that.
Yeah, I'll take a swing at it. From my opinion, you can have a lot of debate about what type of structure they're investing in, which business unit underneath, who they answer up to, all the things you should be doing your homework on from a corporate or a strategic that's going to put money on your cap table. But for the founders in the audience, I'd say it's really simple at the end of the day. I believe that the corporate should be investing just like the pure play financial investors are looking at the deal. And it's pretty vanilla terms nowadays. There's no lick prefs or all kinds of sticky terms. Think about right of first refusal upon sale from commercial agreements. Hey, I want you to exclusively just work for me, or I want to put in a side letter, I'm going to block you off from all of my competitors. Or even I've got a board observer seat in perpetuity, no matter if my own internal mothership decides to start building a competitive product, which sometimes, quite frankly, happens. And that's not a bad thing. It's just that's a big balance sheet trying to look for innovation. At the same time, it could be a great marriage for that point in time, and then you need to be able to separate yourself from that relationships in a certain manner. Again, I think as long as you have someone who's financially incentivized to make sure that happens the right way, it's a good thing as opposed to a bad thing. So those are the things I'd be looking for, and when you really explore this form of capital, I would do my homework on, have they been investing for a while, and do they think about those nuances so you're not having to think about them for them or find them as potholes down the road. And quite frankly, everyone talks about you should do as much homework on your investor as we do on you. We're going to call and back channel all kinds of references. I would just say be very honest with the corporate or the strategic and say, can I talk to a founder where things went well and where things went bad, and understand just not only how that individual is going to act as either a board member or a representative of that investment, but also I really want to sniff out, especially in these traditional industries, if we'll call it that, show me a case study or an example where you've claimed, because I take your money, you can help me get this pilot with this business unit, with this budget, with this milestones that will say, if success looks like this, we'll move on to the next stage. And if they can show you that there's that inroad or at least that hygiene and muscle memory built internal to the company, that's a really good thing. That means you're not going to have to go take your crew, like CBRE was saying earlier, and explore how to engage in the relationship for them. That'll burn a lot of calories, and to the point about watching your cash, that'll also have a big impact on that exploration process. So anyway, just a few things that I'd be thinking about from a corporate strategic investment.
Yeah, I think I would echo a lot of what Ty said. One of the things that a lot of people ask us when we're getting into either a pilot or an investment stage is, what are the restrictive provisions? So are you trying to make it so that we can't work with non-CAT OEMs? And so I think, as Ty said, knowing your investor and just understanding what their value system is really important. We kind of have a rule of we're not putting restrictions on founders, because that's not what we're trying to do, right? We're trying to change this market and bring it into the 21st century. We're not trying to eat you and be the only one that benefits from a new technology. And so I do think that paying attention to those restrictive provisions and knowing the partner that you're working with and the value system of the overall corporation that you're working with is really important.
I think, as you heard from Ty and Meg, the good thing is, I think 5 years ago we weren't here, but today, because the ecosystem has changed, you'll see that most strategics won't ask for the really harsh kind of right of first refusal and a lot of the restrictive rights as they did before. And as a startup, you don't have to educate them in the same way that you maybe have had years ago. If you do run across a strategic that asks for it, know that they're probably in the minority, and that might be a red flag that you may not want to work with them. But a new issue that has been coming up that I've observed, which is pretty interesting, is that these startups don't ask for the rights, but they ask for really steep pricing discounts. And it can be really tempting as a startup company to offer your product basically for free for this new investor that just came in. But I would try to be careful on that, and if you do that, make sure it's a very set term, like 2 years before the sweetheart deal ends and they have to pay full price or at least close to full price. The reason is you don't want that to be set as a standard for others in the industry, and as much as you want to keep these things secret, they always get out, and you don't want other customers thinking that they got a bad deal, or going forward is really hard to raise prices on the ones that you already had this deal baked in. And a strategic, if they're already invested in you, as long as your pricing is reasonable, they'll see enough value to support you that way as well. So that's just one thing that I've seen come across that's almost replaced the restrictive covenants, that is these pricing discounts that strategics have been asking for.
And just to throw a term out there to write down, most favored nation is that funny word that shows up in a contract. And to Mome's point, when you have a sweetheart deal to get that person going that was your first customer, and everyone starts asking for that, it can get really ugly. So I think it's a great point Mome brought up.
Yeah, that's great. Want to talk about a little bit of how a financial investor like Shadow can operate with and do business with a strategic investor. And for founders, want to unpack a little bit of how that relationship and dynamic works. Terms you'll hear, co-investment, right? But there's certainly incentive from Shadow's side, and incentive from the strategic side, as you kind of heard a little bit earlier. Having the balance of a financial investor is really important for a startup, right? So Meg and Ty they have an example of a deal that they did together where they operated kind of in this fashion. Pritzker operating more as a financial investor and Meg as a strategic. So wanted to hear you guys chat about Augmenteer a bit.
So that's a really interesting point that you bring up. And on our original call, Ty and I talked a lot about Augmenteer as a company. And so they basically, they enable digital work instructions for our hands-on workforce. And Ty actually led this deal, and he was looking for additional co-investors. And so at that point, he thought Holt could be a good one to come in. And so while they had done all of the real due diligence, I guess, and the financial due diligence, when they brought it to us, we decided we would pilot it. And so we piloted this in our turbo rebuild facility. And basically what it is instead of our workers writing down what's wrong with their different parts of an engine when they're rebuilding it, they're actually inputting it into the platform, and then also are going through real digital work instructions, which can long-term bring standardization to our work orders. And so that was kind of the main part of our diligence process, was to see, will this work and will our operators actually use it? And so I think once we got through this process, that was hopefully in addition to Ty's investment thesis of, okay, yes, this can be adopted very quickly. Here are some of the nuances. One of the examples was usually Caterpillar dealers use SysWeb to go through digital work instructions, and it's in a PDF format. And so one of the issues was, can we upload our work instructions for each rebuild, or is this going to be something that works for 3 operations and nothing else? And so having us in this position where we're working with CAT to get open APIs so that Augmenteer can ultimately be part of everyone's work instructions that's a Caterpillar dealer, hopefully will be beneficial for both Ty and I. And so we looked at it from the financial perspective, but first and foremost from the implementation perspective, and that gave kind of a first run to Augmenteer and for Pritzker to observe that.
Yeah, and it was great for us because we're early stage investors. First and foremost, it's all about the team. Why are you dropping everything you're doing to do what you're doing? And you have to convince us on that first. Then it goes directly to the voice of the customer. I want to know the ins and outs of why that customer's convicted that this thing will survive and that there's a product market fit to be had. And so the opportunity then, back to your question, Nick, of going over to Holt Ventures and saying, yeah, please do try this out and let us know how it works, because this is one of our big use cases, and quite frankly, it would be a big red flag in diligence if that didn't work out. To get the benefit of what they're going to bring to the table, and then as we've talked about, Holt Ventures does a beautiful job of not putting any kind of crazy exclusivities or commercial terms or any of that. They're just trying to get into good deals with other VCs that are focused on similar thematic areas of interest. So I think those two worlds definitely complement each other. And again, I'll belabor the point. I think there's also an evolution of investors that are meeting right in the middle that are trying to build an LP base to do both at the outset as well. So you can find goodness on both sides of it.
Cool. Yeah, maybe next year, Momet and I will be back to talk about a deal that we did together.
Let's do it.
We'll see. So we understand that we're 4 venture capitalists sitting on a stage, and we imagine there's some startups and other folks in the crowd who might have some questions. So we wanted to make sure we have time for that. So anyone have any initial questions for us? Brian.
I've almost observed two sides of the head within the strategic venturing world. I think there's what Meg described as working within trying to solve internal business challenges that CAT's facing. And then there's the other side of it, like somebody General Mills and 301 is deploying, where it's investing to almost buy down the future acquisition costs, and they're trying to build completely new businesses. I'm just curious, your guys' thoughts on those two strategies. Which you prefer? Do you go after both at the same time?
I've actually seen, that's interesting you bring up General Mills. In real estate, I've seen less of the invest to buy as I have in some other industries. I think it's because generally this industry is still young and the acquisitions will come. But I think that wave is still ahead of us. And in terms of a company, it's interesting, and this is purely based on experience in other industries, which is you definitely will have, if you have a company that's known to invest and then purchase, just be very careful and do extra diligence before going in with a party like that, because one, the outside world will also know they have that reputation, and if they invest in you, they don't buy you, is usually, very reflects negative on you. That is probably not worth buying, right? And it might not be the reason, but that's one. And the other is, even before they buy you, you're sort of seen as this company's baby, right? Like they are in, and actually could discourage people from, discourage other strategics from investing in you. So I think if these players do emerge in our industry, which they might, I don't think there's a ton of them yet, take their money perhaps at a later stage when you already have a broad base of customers and you're nearing that acquisition, and that even if they don't acquire you, you have enough broad base of a customer base, investor base, and traction that you don't really need them the same way you do at a Series A stage.
More questions?
Interested on the specific types of themes that attract your attention. Startup companies, more than the general AI, or the specifics that you look for, make it attractive.
Additive manufacturing gets a lot of press nowadays, but I think of it less about the fancy machines that are, not to undersell extremely complicated technologies, but I think more of the implications on the global supply chain. Everyone thinks of, and supply chain affects all industries, not just prop tech and construction. Everyone knows land, air, and sea as modalities to get freight and things where they need to be. Well, in the future, there will be a fourth modality around additive, where you can have a digital inventory, where there's no more spare parts laying around in a warehouse footprint, et cetera. It's a cloud-based technology that allows the moment you need that spare part or you need this or that, we're moving into this hyper-local, hyper-custom, hyper-now environment that Amazon is helping catalyze across every industry. And so maybe just like a crystal ball theme, I think that's where I'm spending a lot of time thinking about that beyond just the materials and the machines and how that's evolving, but what will be the downstream service implications in post-production, et cetera. And that's where I'd put some thought.
Mine would be kind of a buzzword of constructuring, just kind of bringing more of a process into construction instead of everything being not necessarily like a manufacturing process where there's processes that can be brought in to improve the kind of the flow of the work. And then the other one, as I mentioned with drop-off, is just last mile delivery, and that's excessively important in our industry, and just trying to serve our customers quickly and keep our technicians on the job.
I've been trying to look for something in labor and workforce generally. I think in construction there's a clear need just because of the imbalance of demand and supply, but also kind of in real estate, kind of the new generation of workforce and how do you engage them and all that, both from an employee side as well as a tenant side. So anytime a startup company comes and say they're solving those challenges, I will probably listen. But I have to admit, so far, they're hard problems to solve, right? And I haven't really seen someone do it really well, but still trying to look for it.
We are out of time. The panel is spared because I had a lightning round prepared that none of them had seen, and they all were begging me to reveal the list of questions. So we will have to wait until another day.
So we just made our answers extra long.
Yes, yeah, they got
Sorry,
me. They
Nick.
got me. So with that, I'll turn it back to Dana. Thank you all.